They've got it all wrong. I'm your host, Steve Van Metre, and thanks for joining me today. And the central elites are completely clueless as they can't see that oil and bonds are telling us that something much worse is coming. Let's go to Bloomberg, where we picked today's story up as Powell sets stage for slowing Fed rate hikes amid hawkish tone. Powell is scheduled to deliver a speech nominally focused on the labor market on an event tomorrow at the Brookings Institution in Washington. It will be one of the last from policymakers and perhaps the most important one before the start of a quiet period ahead of their December 13-14 meeting, where we're largely expected to hear Powell raise rates again. Now, I want to understand the importance of this speech, which we will note will be pre-written, and he will just read from his script. And the reason this will be so closely watched is because this will be a precursor to that meeting. Now, even though the Fed does vote on policy, what the Fed chair wants, the Fed chair gets. And in this case, everyone's going to be looking at this meeting to see what the plan is, at least at the moment, for that upcoming Fed meeting, even though we've got some more data that's coming out, and I want to show you just how much they've got this wrong. But I just want you to be aware that this upcoming speech is very critical. He's probably going to use a speech to be hawkish and describe the dimensions of imbalance in the labor market, something that we're going to completely destroy in this show. Powell could frame those labor market dynamics as a reason they need to be committed to tight policy for longer. Now, what the Powell misses, even though he's claimed he looks at this and in the past he's used it as a guide, what he's missing is the bond market is telling him that you need to stop raising rates and lower them, and you need to do it soon because you're causing irreparable damage to the economy. And I want you to see this. Let's go over to the Department of Treasury here. We've got a chart of 1 month all the way out to 30-year Treasury yields. And what I want you to know that from 5, 7, 10, 20, and 30, so 5-year and longer duration yields are all lower than the 1 month yield at 4.1%, 1.6% the other day. Now, what this means is the question is, who is actually propping up the front of the curve? That is the Fed. What is the longer end starting to tell us, particularly with fives, and notably threes are close to inverting too? It's telling us that the future path of growth and inflation are actually heading lower. And the Fed is causing a problem here by artificially holding up short rates when the bond market is saying in a big way, hey, Fed, you need to lower those rates or you're going to cause the economy to grind to a halt. And as we'll see when we look at the labor market data, we look at oil, we know what's coming. And the Fed, once again, seems completely clueless to this obvious signal. Minutes from the November 1 and 2 gathering showed widespread support among officials for calibrating their moves, with a substantial majority agreed it would soon be time to slow the pace of rate increases, indicating that perhaps some of the board members are seeing that the damage they're causing will have widespread effects. But views around how high they will eventually need to lift borrowing costs was less clear-cut, with various policymakers seeing a case for going somewhere higher than expected. So what you're seeing here, at least in the minutes, is Fed speakers saying, hey, you know what? Maybe we're going too fast. We need to slow down. But notably, the peak is a lot higher. And once again, the bond market here is being very clear, and I'll show you on the next chart, that they are making a huge mistake, that higher rates aren't the path, it's lower rates, because at this point, we've already started the spiral down, and they can't see it. Here we've got the 10-year 3-month yield curve, which is 10-year yields minus 3-month yields. And we note these inversions when 3-month yields are higher. And what you see here following every one of them is a gray bar indicating a recession. What we know now is we have the deepest inversion since the dot-com bubble, indicating that, yes, we are on a trajectory for a recession, even though the Fed says that they just want to slow the economy down. They don't want a recession, and they certainly don't want a deep one. But we can note right now we are already on that path. The Fed chief will be speaking on the same day that the Labor Department will issue an update of its job openings and labor turnover survey, or JOLTS, which is a highly lagged report and one that Powell cites often for evidence that demand for labor is greatly exceeding supply. Job openings unexpectedly increased into September. Again, we'll challenge that point as well. And another strong reading could suggest further wage pressures, which I think is somewhat unlikely to happen here. But in Powell's mind, the more job openings there are, the greater demand for labor, and that means employers will raise wages, and that will lead to a wage price spiral where higher wages lead to higher prices and rinse repeat. They don't want that, and I want you to be clear about what they don't want. They don't want you to get a big raise. They do not want that. But if we're looking at this JOLTS report coming out tomorrow, well, it's probably not going to indicate that there's more openings. We're should see a decline. What we can note is the job openings and labor turnover survey in blue has a strong relationship with the stock market, and this bump that they said that was unexpected was really largely probably a reflection of the stock market rebounding off some of its lows. The trend of the market is lower, suggesting that the JOLTS, which is a 2-month lagged report to begin with, should indicate fewer job openings on Wednesday. And now this turns to oil as oil plunges to the lowest since 2021 as China unrest rattles the market. And of course, now the story about oil is turning into China, but maybe that's really not the story. As West Texas Intermediate sank towards 74 a barrel following 3 weeks of losses, while Brent traded around 81. Protests over harsh antivirus curbs erupted across the world's largest crude importer over the weekend, including demonstrations in Beijing and Shanghai, spurring a broad sell-off in commodities as the week opened. The rare show of defiance is raising the threat of a government crackdown, but the question is how does this come back to oil? And I want you to see the way the media is spinning this is, hey, oil's weak because of China. In reality, oil is weak because the global economy is slowing. Demand is getting weaker, and that's what oil is starting to price in, is that the future demand and growth of the economy, much like the bond market, is telling us things are actually going to get worse and not better. And now from the Fed's perspective here in inflation, I want you to see that as the Fed continues to tighten because they think inflation is going to stay higher, oil is saying just the opposite. Here we have a chart of crude oil prices against gasoline prices. Of course, we note that crude oil prices lead gasoline prices, and that makes perfect sense. And what we can see is crude oil sitting just above a 0% year-over-year rate of change, with gasoline not too far behind. Now, what that has to do with inflation, well, first let's look at this chart of a 1-year snapshot of crude oil prices. What I want you to note that by late January, early February, presuming that crude oil prices stay the same as they are now, and of course they'll probably change a little bit, what that means is the year-over-year rate of change of crude oil will be at 0, and then going all the way into the summer months, again, assuming price stays the same, will be negative. And what that means for inflation is that gas prices also on a year-over-year rate of change will get back to 0 and possibly then go negative as well. Again, not negative in price, but a negative from a year-over-year rate of growth. And we can note that in this chart, consumer prices in blue have a strong relationship with gas prices in red. So if gas prices on a year-over-year rate get back down to near this 0 mark, maybe a little below, what that tells us is that inflation should be right back around 2.5%, which, as many of you know, is the Fed's target, suggesting what the bond market's already saying is they've got it wrong, they're totally clueless, and they should be cutting, not raising, because they're now going to take a big cut out of the job market, and they can't see it coming. U.S. jobs report likely to show subtle progress for the Fed this coming on Friday, as payrolls are projected to have risen about 200,000 in November, a second month of decelerating gains, and likely that trend is going to continue, as we'll prove here in a moment. Such growth, while moderating, is nonetheless consistent with solid hiring that will extend the Fed's rate hiking campaign into 2023, but perhaps may not, as the report will be the last of its kind before the central bank's final policy meeting this year. And not only that, we have a CPI report coming out as well, so there could be two indicators that give the Fed reason to at least perhaps go even lower than we expect, with 50 basis points being priced in. Now let's take a look at the labor market. I want to show you that crude oil and the bond market think the Fed's got this one wrong as well. Here we can note that all employees totaled non-farm on a year-over-year rate of change in blue against crude oil prices on a year-over-year rate of change in red. And we note that decelerations in crude oil, expectedly headed into a recession, indicate slowing demand for labor. And that is what we should expect to see in that report on Friday, which is also validated by the yield curve. And so I want you to see the damage the Fed is causing here, because these deep inversions, as you can note here down in red, lead to a slowdown or deceleration in payrolls and eventually trigger a recession. So now you can see it. The Fed is completely clueless. They can't see the damage they're causing. And at the current trajectory we're headed, both crude oil and the bond market is saying that things are going to get much worse. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.